Hello and welcome to Macro 2.0, where we talk about big ideas, big institutions, and big money. Last time we got together, Barry and I, Barry Nielsen from Opportunity Bank, we talked about stocks, one major class of assets that we want to deal with. Today, we're on to bonds, and this is in your area of expertise. So I'm going to say as little as possible and draw from you some knowledge that we can share with the public. So I need to start from square one. You know, what is a bond and how is it distinguished from these other asset classes like stocks and cash?
Okay, well, a bond is a debt obligation issued in the form of a security. Bonds are issued by corporations and governments, potentially other institutions, to raise money. And a bond is a future stream of cash flows. Okay, for our purposes here, for the rest of our program here, we're going to talk about fixed rate bonds, because there's so many different types of bonds that have so many different characteristics, like floating rate bonds and bonds that not only pay interest on a monthly or a semi-annual or an annual basis, but pay principal as well. And so just to make the distinction right off, we're going to limit this to fixed rate bonds that pay principal at maturity. And so when I say that, what I mean is a bond is a stream of fixed cash flows based on the coupon on the bond, which is the interest rate. Think about the interest rate on the loan. So bonds pay interest on a periodic basis. For example, U.S. Treasury bonds pay interest semi-annually, and they return principal at maturity. So if a bond, or the U.S. government issues a Treasury bond with a face value, and now we're not being realistic here, but we'll say a face value of $1 million, and it has a coupon of 5%. That means it's going to pay 5% annually, but those payments are going to be made semi-annually, and at maturity, if it's we'll say it's in this case, a 10-year bond. 10-year bonds issued by the federal government, the U.S. Treasury, are actually called notes.
Yeah. We were talking earlier about there's a language that associated with this arena of economic activity, and it takes a while to get the hang of it, but there are treasuries and there are several types of treasuries.
Yes.
So a note is a 10-year treasury.
But the important characteristics of a bond are its maturity. Is it a 10-year? Is it a 30-year bond? The coupon, which is the interest rate that the bond pays. So going back to my example I started there, it might pay a 5% coupon, and at maturity, as the investor in the bond, as the owner of the bond, you would receive the principal would be paid in full. That $1 million would be paid in full. Now, the important part about a bond is, again, if you're an investor, the maturity of the bond. And bonds, and we'll talk, I'm sure, a little bit about price and yield, but a bond's maturity has a big impact on the price of the bond given different interest rate environments. And why I say that is because, again, a bond is a stream of future cash flows in the form of interest payments, also known as coupon payments, and the return of principal. And if you're going to receive any stream of cash flows in the future, you're concerned about inflation. Right. Because as we've talked in past episodes, inflation erodes the value, your future purchasing power. So when inflation expectations and inflations go up, or interest rates go up, because interest rates are very much a function of inflation, because again, if you're invested in a bond or some other type of investment that pays a fixed interest rate, you want to ensure that your rate of return, will say, is greater than the rate of inflation. Yeah. If it's less than the rate of inflation, you're in a negative return situation.
Right. My $1 million isn't going to buy me what $1 million would have before I purchased the bond.
That's right. So if you're if you've bought a 10-year bond and you're expecting to return principal in 10 years, well, you're concerned about the rate of inflation and the level of interest rates. And I'll make another point just real quickly without going into too much depth here. So the longer a bond's maturity, because again, bonds could be issued as, for example, a 3-month T-bill where interest is returned in 3 months. Well, in 3 months, you're not too concerned about
pretty short term.
Yeah, where inflation goes in 3 months, because there's not that much chance that inflation could go up over the next 3 months, or your purchasing power is going to go down within a 3-month time horizon.
Yeah, we're not Venezuela.
No,
bad things don't happen so rapidly.
Yeah, that's a good point. But over 30 years, who knows what could happen? Inflation, we could enter very easily a period of high inflation, so your $1 million, when it's returned at maturity, is not going to be worth as much. So interest rates have a big impact on bond prices. Okay, a lot of bonds, corporate bonds, for example, have a credit aspect as well. You would be concerned about the creditworthiness of the bond issuer.
Right.
Over that course of 30 years, is whoever issued that bond, are they going to remain creditworthy, and are they going to be able to continue to make principal and interest payments? So interest rates and credit impact the price of a bond. And again, just think of a bond as a future stream of cash flows, and how certain are you to receive that future stream of cash flows? Anywhere from 3 months out to 30 years. Some nations have actually recently issued 100-year bonds.
Wow.
There's even perpetual bonds that never mature.
Methuselah bonds.
That's right. So bonds are, they're very interesting in that, and they're not the simplest form of security to understand. But I think if you break it down into a stream of cash flows and understand how inflation impacts that future stream of cash flows in your purchasing power, and the uncertainty associated with longer maturity bonds, you can understand that a bond's maturity is very much, interest rates have a bigger impact on bonds that mature 30 years from now than they would 3 months from now.
Yeah. So, if I understand things correctly, the longer term attached to the bond you purchase, the more risk you're actually willing to take, because it's harder to predict the future 30 years out than it is 3 months out. So is there, in terms of the interest rate or the coupon you're going to get paid, normally would your interest rate be higher for a long-term bond than a short-term bond because of the risk associated with that?
I couldn't have said it better myself. Absolutely.
Okay. Then we're talking about different types of bonds and their credit worthiness of the issuer. My take is that the U.S. government is sort of like the premium bond issuer in the world. We've talked about reserve currency and the relative strength of the U.S. economy, but also the credit worthiness. Even though our government toys with defaulting on loans and bonds from time to time, it hasn't happened, and everybody else is perceived as a higher risk. That's probably overgeneralizing, but the U.S. government is sort of the place to which people flock when the credit worthiness of, say, large corporations that may be on top of the world today, but who knows, tomorrow, the next day, the next year, the next 10 years. So is that a fair way to characterize treasuries? They're sort of the cream of the crop in terms of stability and a surety of bonds being repaid.
Yeah, everything you just said is 100% correct. The yield, which I'm going to say the interest rate on U.S. Treasury bonds, is considered a risk-free rate. Okay, now it's risk-free in terms of credit risk. The world assumes that the U.S. Treasury, the U.S. federal government, will never default on its debt. Okay, so it's considered, from a credit aspect, the risk-free interest rate. Now it still has, as we talked about, interest rate risk, because as levels of inflation and interest rates go up and down, the price of a U.S. Treasury bond can change, again, because that future stream of cash flows, when you receive those dollars in the future, they might or might not be worth as much as they currently are.
Yeah.
Now, along those lines, I'm going to talk about something called yield. Okay, a bond's yield is similar to a bond's interest rate, but it's also a function of a bond's price. Okay, let's think about yield as the rate of return on a bond.
Okay.
Now, that rate of return is going to change as interest rates change, and the bond's price is going to go up and down. But if you buy a U.S. Treasury bond, let's say a 5-year Treasury note, and you hold it for 5 years, you will earn its yield. Okay? If you sell it before the end of that 5-year period, you're most likely not going to earn the yield at which you bought that Treasury bond. Okay, that's a little bit different from, will you still have the same purchasing power that you thought that you were going to have? For example, I'm going to switch to 10-year Treasury bonds now. Okay. 10-year U.S. Treasury bonds are, as of today, are currently yielding about 3.12%. Okay, if I bought a 10-year U.S. Treasury bond today, I held it for 10 years, I would earn 3.12%. Guaranteed, because it's the world's safest investment. Okay, that doesn't mean, again, that 3.12% is going to be worth 5 years from now in terms of purchasing power.
So now we're automatically factoring in that inflation factor, but the yield is a little different dimension.
Okay, and you bring up a really good point there, that yield represents market participants' expectation about the future level of inflation. Okay, this is why I like bonds. They tell you so much about the economy, about what the market, and when I say the market, I mean everybody that's buying and selling bonds, institutions, individuals, governments, whomever, what they think about the future level of interest rates, which is interest rates are a function of the economy. So bond prices, that yield, it's a prediction about the future level of interest rates, which are a function of the economy. So it's a prediction of where the economy is going.
Yeah.
Bonds are very interesting that way. They have a lot of information embedded in their price. But again, that yield is a very important number for a bond investor. That is again, talking about U.S. Treasury bonds where the market says there's no credit risk, that's your guaranteed rate of return if you hold that bond to maturity. That doesn't mean that your purchasing power will be the same, but that's the rate that you're going to earn. That's why bonds are called fixed income investments, okay? Because you're going to receive a fixed interest payment in the case of U.S. Treasury bonds semi-annually, and then you're going to receive the principal at maturity. So it's a fixed stream of income, and bonds we talk about fixed income markets and fixed income asset class. That's why bonds are called fixed income.
Yeah.
Now, as we said, we're talking about fixed rate bonds. There's a lot of different kinds of bonds, but
yeah.
Fixed rate bonds, that's what we're talking about.
Okay, you've got me going down two channels of thought at the same time, so I'm going to try and get to them both before we run out of time. You know, we've been talking about the good bonds, the safe bonds, the reliable bonds. People I know have heard of or actually suffered from or benefited from something called junk bonds, which I would gather is, connotes the credit worthiness or the quality of that bond. It's somewhere below the credit worthiness of a U.S. Treasury. What is a junk bond, and how does it hurt or benefit people who own them?
Okay, well, you're absolutely right. A junk bond, if you're in the industry, you don't like the fact that they're called junk. You would prefer high yield.
Okay. Yeah.
Because you're right. They have
sounds a lot better.
They carry a higher interest rate, or they have a higher yield, certainly than U.S. Treasury bonds, because the creditworthiness of the issuer of that bond is certainly not the same as the U.S. federal government or the same as, we'll say, ExxonMobil, just for the heck of it.
Yeah.
Which issue very highly credit-rated debt. So they're bond rating agencies, S&P, which is Standard & Poor's, Fitch, and Moody's. They all put a credit rating on bonds. Anything rated above BB is called investment grade. So something rated BBB would be investment grade. Something rated BB is junk or high yield. Okay, and because of the creditworthiness of the issuer, that bond is the investors are going to demand a higher rate of return, a higher yield than a bond that's rated BBB.
Okay, and the governments as well as companies are rated. I just want to bring that in.
Absolutely.
The bond rating entities that you mentioned are very important signalers of the quality of the bond market itself and the people who are issuing bonds. So it would pay us to pay attention to the bond rating, for example, of the state of Montana or U.S. government or a corporation. Okay, the other thing I'm dying to ask you is, okay, last time we talked about stocks. What is it principally that motivates an investor, and we can talk about individuals or institutions, to choose to go into the bond market as distinct from the stock market? And I know most sophisticated investors are in both places at the same time, all the time. But what's the trade-off between going one direction or the other and preferring bonds over stocks or vice versa?
Well, I would start off by saying I speak with caution because we kind of live in extraordinary times. However, typically, when the economy cools, we think about what happens. When the economy cools, inflation slows, inflationary pressures become less, interest rates fall. Okay, when interest rates fall and inflationary pressures become less, going back to what we talked about, those future cash flows or cash streams from a bond in terms of purchasing power become worth more.
Yeah.
So bond prices go up generally when inflation falls as a function of the economy cooling. Okay? The opposite happens with stocks. Typically, when the economy cools, business slows, so stock prices move lower.
Yeah.
So traditionally, a investment portfolio that was comprised of some amount of stocks or equities and some amount of bonds were used as diversification.
Yeah.
Okay, and that's a whole topic on portfolio management and risk management. So, a structured portfolio between equities and bonds, the stocks would offset the bonds, and the bonds would offset the stocks in different economic and interest rate environments. Again, I would caution people that we live in really unique times. I mean, interest rates are really low, yet the economy has been expanding at, albeit at a fairly slow pace, but expanding nonetheless for the last 8-9 years. But interest rates haven't spiked higher. And where we go from the economy now and where interest rates go, who knows? I mean, we don't know. But diversification between stocks and bonds has traditionally been a way for investors to structure a portfolio.
And you're balancing different types of risk. I mean, they're all associated, the risks with interest rate increases and growth in the economy and all that. But my understanding is that a diversified portfolio is that because you're betting on this and that, and they offset one another, because they move in different directions under different conditions.
That's right.
Or the same conditions cause different movement.
That's right. We call it negative correlation between asset classes. Now, one other thing I'd make real quickly, as people near the age of retirement and they're going to start drawing down the principal amount or accessing their retirement funds, typically people shift to a much higher allocation towards bonds because they are, as the asset class name of fixed income suggests, they're less volatile in price than stocks. I mean, stocks, historically have lost as much as 40-50% in a single year. We typically don't see that in bonds. Now, there's different types of bonds. There's high yield versus U.S. Treasury bonds, and that's something to consider in terms of, how we're talking about portfolio management now, but when do I need my money, and how certain am I that I need that amount of money within a certain time frame? But that's why it's called fixed income investing. And as people near retirement, that's why a portfolio allocation towards more heavily weighted toward fixed income is probably wise and prudent.
Yeah, good. That's what I'm starting to think about.
Me too.
Okay, the last quick question, because we are out of time. But you've said a couple times we live in these extraordinary times. There's a lot of signals that are contrary to expectation. And one of those is the yield curve. And without getting into too much detail, if I understand correctly, we're approaching a point where those long-term yields are telling us something about the economy, and there's an inversion of the normal relationship between the longer-term bonds and the short-term bonds. Can you address that just real quickly?
I'll go as quickly as I can. I already said that there's a tremendous amount of information embedded in a bond's price or a bond's yield. So the yield curve represents the yield on U.S. Treasury bonds. Well, there's different yield curves, but we'll say the U.S. Treasury, the most watched yield curve, U.S. Treasury bonds, we'll say from 3 months to 30 years. Okay, and as you pointed out earlier, you would expect the yield on a longer-term bond to be higher than a short-term bond because there's so much more risk that something could happen over those 30 years. So the relationship between the yield on a short-term bond and a long-term bond tells us a lot about where the investors think the economy is going. When that yield curve starts to flatten out, which it has over the course of the last couple years, we'll say, that's a signal. That's a signal about what investors think about where the economy is going, where interest rates are going, where inflation is going. Again, that yield curve, it's really a graphical representation of the yield. It's a line. Yeah. It has a slope. It's a chart with a graph with a line with a slope. And the level of those yields from 3 months to 30 years says a lot about what investors think about what the future holds and where the economy is going. You don't want to see an inverted yield curve, because if short-term rates are higher than longer-term rates, hey, investors are saying the economy is slowing because we think inflation is falling in the future, and that signals a slowing economy. Yeah,
and so there, generally speaking, less confidence in the future than in the immediate period.
Absolutely.
So, and just make your money now.
That's right. When I say inverted, I mean a downward sloping yield curve as opposed to an upward sloping yield curve. Again, going back to what you said, because if the economy is growing, interest rates are rising, that curve's going to be upward sloping. If it inverts and it's downward sloping, that's where we have problems.
All right, Barry Nielsen, thanks again. Giving us a lot to think about. Watch out for the inverted yield curves. They're mysterious and dangerous, maybe. Who knows? We live in interesting times. Thanks so much for being here again. Thank you, Opportunity Bank, for sponsoring this series. We'll see you next time where we'll talk about trade policy.